This is TIP100, your source for stock market trends. I am super excited to be here today to talk to you about your endless options. Now, before we get into it, a little disclaimer here. This is all for educational purposes only. Please don't trust us. Do your own research. Consult a professional. Trade with a plan. All right, now let's get into it. From Mike from Philadelphia, wanted to know what an option in finance was. So we drew him this beautiful picture to describe the four main features of an option. An option is a contract with four important features that we're going to give you right now. So the first feature is the type of the option. There's a call option and a put option. And it's important to distinguish the two, because a call option gives you the right to buy 100 shares of the underlying security, and a put option gives you the rights to sell 100 shares. An option is always 100 shares. But depending on the type, you're either buying 100 shares or selling 100 shares. So that's the type. The second feature is the expiration date of the option. So the expiration gives you the time value associated with the option depending on how far out you are. An option 1 year out is going to be worth a lot more than an option 1 month out or 1 week out. But the important thing to remember is the greatest time decay in the option occurs in the last month before expiration. And we actually go into this in our first book, The Inflection Point, where trading meets investing. So if you want a little refresher on the theta of the options, you can read that book. The third feature is the strike price of the contract. It's always in there. You need a strike. Now, depending on what option you buy, you could buy an at-the-money strike price. Let's say the underlying security is trading for $100. Well, the at-the-money strike would be $100. You could also buy an in-the-money strike at $95 if the strike prices were that close together, like 195, and then the out-of-the-money would be 105. Now, when you buy an in-the-money strike, you're paying a lot more for that option because you have $5 of intrinsic value, and that 5 times 100 is $500. So the in-the-money strike at 95 would be $500 more than the at-the-money strike. And the out-of-the-money might be really cheap because it's probably going to expire worthless. So that's the strike. The last feature is the premium, the options premium, which is what the option is bought and sold for in the market. So the premium always has a bid and an ask price. The bid price is what you can sell it for, and the ask is what you can buy it for. Now, depending on how heavily the underlying security is traded, the bid and the ask might be pretty far apart. It might not make a lot of sense to be buying options depending on the underlying security. But there are some stocks out there that are really heavily traded, and the bid and the ask are pretty close. And you kind of want them to be really close so there's minimal slippage getting into and out of the trades. And that's basically the four key features of the options. It's all spelled out in our next book, Creating Wealth While Serving Your Country, which will be available shortly online. So look out for that. Email info@theinflectionpt.com with comments or questions. Keep big tipping.